Good morning, everyone. Welcome to this episode of the CPO series. Our webinar today will be the second part of our mini-series on product ROI, hosted by Dragonboat. And I just want to make a quick mention about this mini-series before we get started. So Dragonboat hosts webinars on a regular basis for the product community. And with this webinar mini-series, what we're hoping to accomplish is something special. With the help of our incredible participants, we wanted to dig into the subject of product ROI, why it matters, how to calculate it, and how to optimize it within the product organization. And we believe this is relevant across the board, so to CPOs, product managers, and product operation folks alike. I'm Alisa, and I'm a product manager here at Dragonboat, and I'm joined today by my co-host Anna and our special guest Denise Hemke. To kick us off, we'd like to hear from you. We'd love it if you can introduce yourself right in the chat where you're joining us from today. And for now, I'm just going to cover a few quick housekeeping notes as we're all introing. The first note is that this is a half-an-hour session. It'll be recorded and it'll be available on demand later with all our other webinars. The second is if you have questions during the presentation, you can submit those using the Q&A function, and we'll either take them live or we'll have a dedicated Q&A at the very end of Denise's talk. And finally, as you probably know, Dragonboat is a SaaS platform that enables product leaders to accelerate outcomes. So do check us out at dragonboat.io to learn more. And my co-host Anna is going to drop that link in the chat for you. So without further ado, I'd like to intro today's guest, Denise Hemke. Denise is a CPO at NEOGOV, and she runs the product organization of a robust HR and public safety platform for the public sector, where her mission is to serve people who serve the people. I love that. Previously, she was the CPO at Checkr and general manager of analytics at Workday. Denise's experience is marked by a deep commitment to analytics, strategic planning, the development of customer-focused products. So we felt that she was the perfect guest to invite to talk about how to measure product ROI. Welcome, Denise.
Thank you. Thank you for that introduction. I am really happy to be here with you all today, and I'm excited to talk about product ROI because I feel that this is so critical to the success of any CPO, or as Alisa said, any product leader. And I've seen a lot more rigor, especially in the last 5 years, which tells me that the criticality of measuring product ROI is only increasing. Now, before we jump into product ROI, though, I'd love to start by kind of giving you the backdrop for why this even matters and how we got here. Now, product management has been around in different flavors for a really long time, so I'm not going to give you the history of product management, but I do want to zero in on the start of really Scrum and Agile in the 90s. Number one, because this tends to be the foundation for the product management practice that we all kind of see and adhere to today. But also, as I've been in product development for about 20 years now, be that in engineering or be that in product, I've really seen this practice evolve. And I think if you go back to that early period of Scrum and Agile, it was always centered around the customer, right? That was always true. But I felt like at the time that a lot of what we heard for why things were prioritized was really based on a lot of qualitative data, right, or qualitative information and anecdotal data at best. And there were some methodologies like the Kano model that was developed in the 1980s, but I would argue in aggregate, this period of time, really through the 90s and to that 2010 kind of timeline, was really the era of more qualitative decisions. And what started that shift then? It was really in 2010 or so that many of these product analytics products really started to come to market, which started to truly enable a more quantitative lens on the product management practice. I think if you can rewind the clock then too and remember what things were like at those times, I certainly do. It was also about data democratization, right? Everybody started to get more data at their hands, data in their fingertips, so that they could really analyze the key critical information, and they had the great tooling to do it. And so what I think that translated into for the product management practice is this shift in expectation that we weren't just, justifying our priorities based on anecdotes or what we've heard from customers, but really a data-driven approach to that. And now I think what the norm has become is that every product manager is expected to be data literate and make data-informed decisions. I think you add to that, this recent shift that's happened where, kind of free money came to an end in 2022, right? The ZERP era is now officially over. And I think what that means for product leaders is that the qualitative and quantitative justification that we've historically been doing was no longer good enough. And what do I mean by that? I mean that, we'd always been in this growth mode where we had been able to add and invest in more and more, but now we were faced with choices, right? Given a fixed envelope, where am I going to invest? And because that envelope is fixed, we also have to ask ourselves, it's not just about those go forward investments that we need to scrutinize, but it's also our existing products, right? The existing investments that we've made. Are they yielding the results that we had originally expected? Because if these new investments or our existing investments aren't giving us either these early signals or producing the business results that we anticipated, then we need to shift those investments, right? We need to free up these valuable resources, which means putting products into maintenance or even killing products, right? Stopping them altogether to focus on higher ROI opportunities. And well, maybe none of what I've just said sounds novel, right? You'd say, well, Denise, of course, like that's what we should be doing. I would say that I think it is a new muscle for many of us to flex. And outside of my role as CPO, I'm the San Francisco chapter lead for Products That Count, which is a community of over 500,000 product people. And as I spoke with many product leaders last year, really in this capacity, what I found is that they were taking these steps for the first time really in earnest. And again, I wouldn't say that they never scrutinized new investments before, they did. It was just that they had to do it much more judiciously because they couldn't greenlight large swaths of investments. They had to be much more selective about what they moved forward and said, yes, we're actually going to pursue this one. And they really had to go back and do that, heavy work and that tough work of saying, what are these products we want to put in maintenance and what do we want to stop? And so I think all of that has really led us to today's discussion around product ROI. How do we measure, what our products are doing and the outcomes that they're enabling? And then how do we then make those decisions? So with that backdrop, I'd like to talk about, two tools that I commonly see leveraged to really show the analysis behind our investment strategies. And the first tool that I've commonly utilized is a business case, right? When a product leader is looking at a multi-quarter or multi-year investment, then you really need to show your work, show your assumptions to really help align your critical stakeholders that this is the right investment to make. This business case, as you all know, also functions as the beacon for what do we need to build, why do we need to build it, and answers that question of why now. The one thing I'd like to highlight that I think is another shift in this area, though, is that business cases have been commonly used, I think, for looking at the growth side of our business, right? Where are we expecting new revenue to come in? But if you think about 2022 and really the shift that drove, and there's other things at play here like AI as well, but the shift that 2022 drove was also this focus on where can we reduce costs, right? Where can we improve our product margins and ultimately get to a path of profitability, right? Especially if it's harder to go raise money, right? That's how these two things are connected. And so what I believe and what I would say is that, not only should these business cases be used for, where can we grow revenue, but we should also use them when we're analyzing these cost-cutting measures. And so I'll give you a great example. You hear a lot of companies talking about how they're rolling out chatbots, for example, right? Taking advantage of AI capabilities to potentially displace future spend or even current spend in maybe customer support types of roles, right? Making those roles more efficient so that they can do more over time, service a larger customer base with less. Well, that type of investment doesn't come for free, right? We have to invest in that as product leaders. And so what I would say is the business cases, while they're great tools for measuring our revenue and have historically been used for that, you should really be using them for any of these large scale investments, be that new net revenue opportunities, cost savings initiatives, or even large scale infrastructure, right? They're an opportunity to really give that same level of rigor and analysis to all of these opportunities that we're faced with, because these are the things we're trading off against. The second tool, which is really complementary to the business case, is a prioritization framework for our intra-year planning. I'm used to quarterly planning, so you'll probably hear me use that interchangeably here today. And I'll go back to the business case, right? A large portion of our R&D resources is going to be allocated to these very strategic investments, right? But that's not everybody. There's a lot of other work that we have to do that's gonna fall outside of those business cases. So how do you make these investment and trade-off decisions on that body of work? And this is where a prioritization methodology really comes into place. So at both NEOGOV and Checkr, my teams have used RICE. And what is RICE, right? It is really a way to measure reach, right? Who's going to be impacted by the solution that you're offering? What is the impact, right? What is that impact that you expect to have on these users? Confidence, right? How confident are we in our hypothesis around both the reach and the impact? And then finally, effort. Like, what is it going to take for us to successfully build this capability? And what I believe is most valuable about RICE, or really any methodology that you adopt, is both the consistent evaluation as well as the consistent usage of this methodology. And I'm going to double click on that more here in a minute. But at the highest level, I think what RICE gives you as a product leader is the ability to kind of dig in and inspect the analysis and the decisions that your product managers are making at scale without you being in the day-to-day of every single one of these things, right? The other thing it gives you is it gives you the ability to make sure that you're allocating investment across the most important and most high ROI work in your entire portfolio. And again, I'll touch more in a minute on how we can do that. But before we dig in there, let's take a quick poll on what ROI framework are you using today to prioritize your own roadmap?
So we'll give just half a minute here and let's see what people are answering.
I'm very curious.
Yeah, all right. So it looks like, oh, I'm actually quite surprised by this. All right, so I will stop the poll now and I'm going to share the results. 45% of us are following no framework.
Well, this is going to be a good session for you then. So hopefully I'll convince you 45% at the end that you should do something. Maybe RICE is the answer for you. Maybe it's a different answer. But I really think that doing something is the big takeaway that hopefully you'll gain from this. All right. Well, now let's dive deeper into the business case. And again, I'll start with the goal. The goal of the business case is to really show our analysis, right? To show our work, to help align critical stakeholders on why we should make this specific investment. It also allows us to compare investment options, right, with the same measuring stick. And that's where that consistency really comes into play. So for today, I want to zero in on really the most relevant aspects of the business case to product ROI, though. So first, market analysis. Who are we building this for, right? Are we building this for existing customers? And if so, which ones? Does this open up a new market for us? If so, how big is that market? On the product vision and plan, what do we need for the MVP? But what work do we also need to really win in the market, right? Those two things may be very different. And how might we sequence that work? And what's the cost to build each one of those different phases? The third thing is really the business model projections. How do we plan to go to market with this new capability? And given that business model, right, what are the associated financial forecasts? Because if I look at the data really from these three sort of distinct areas and bring that together, that's what gives us line of sight to our product ROI. So I'll go back to my time at Workday, for example, where we got a lot more rigorous about this. Each business unit modeled the entirety of our portfolio in a spreadsheet that we updated at a regular cadence to really look at that, to start to look at, what is our cost to build and what is the anticipated revenue that we're getting. At Checkr, we started creating these business cases before we made any strategic investment. And so no matter how you approach it, I really think the piece that I'd love for you to take away, again, is that consistency in your approach to analyzing your investment opportunities. So at both of these companies, I will say, like, what we focused on was our cost to build to the revenue that we generated in that first year post-launch. And the range is going to vary. I'd love to be able to tell you, hey, here's the magic number that you should be aiming for, but everybody's product is different, right? Workday, as you could imagine, high recurring revenue products, typically because of that complexity, often takes very large teams and longer periods of time to build them. By contrast, Checkr might be, a lower revenue producing product because they're a more transactional model that is a lower price point, but we can also operate with a much more lean team building that. And so, from a revenue perspective, I can't give you guidelines on like what does good look like for your company. But I think when you do that math to say, what's the revenue that we anticipate 1 year post-launch versus the cost that we put in to build the product, in an ideal state, you want that to be one, right? I want every dollar that I put in to build, I want to gain that back in revenue in that first year. And for the things that don't hit that one mark, I'm typically scrutinizing those to say, is this the right thing that we should be investing in? And for some initiatives, some projects, you may well exceed that number, and that's amazing. Sounds like a great investment. But the more you do this across the things that you're investing in, the more you can start to normalize as to what good looks like for you and your company. The second thing that we looked at, especially at my time at Checkr, was really the ongoing investment and expected revenues. So we typically forecast out for 3 years as a real sort of check and balance system, right? Are we going to get efficiencies over time and therefore enable an improvement in that that revenue to cost ratio? That is certainly the goal, but without you doing that inspection, you could be deferring a lot of work, for example, that you think is necessary to really win the market and not getting the revenue growth immediately or getting that momentum, and you could be backloading that. And so you could find that that's not true. And so I would say I'd encourage you to model out over a longer time horizon, like a 3-year period. I'd also say that revenue can be a lagging metric. So you need to, in your business case, also articulate what are the other measures that are going to give you early indications that you're moving in the right direction, right? And that you should continue investing. And so I'll give you some examples here in just a moment that I went through in my experience. But, if I'd be remiss if I didn't say this, that the business case is a forward-looking tool, right? Where should we make investments? But it shouldn't just be a forward-looking tool. And I'll wrap up towards the end of this with this as well. But you should be using this to look back, right? Because that's how we get better, to say, what did we anticipate and are we getting the results that we expected? All right, so let's walk through some of those real world examples. So I'm going to talk about 3 different products that I've had the experience of working with. And in this first scenario, we had an existing set of products that we sold via traditional sales channel, right? A typical sales-led growth model. And we were looking to add a product-led growth motion to really diversify the segment that we were selling this to, and to make sure that we could do that in a cost-effective way, right? So that there were good unit economics. But building that product-led growth motion was going to be a significant investment for the team. And so initially what we started with was a small investment in the buying experience, a very limited way of buying the product. And we focused on a single product. And then if that would prove to be successful, then we would double down on that investment, right? We'd both expand the buying experience and create more ways for them to buy, and then we'd roll this out across our entire product portfolio. But we wanted to begin with one. And so what were those early indicators that we looked at beyond revenue? So we looked at our product attach rates, and we looked at them by segment. And we did that so that we could validate, hey, the segment that we're anticipating is really going to leverage this motion is indeed the segment that is using this to purchase the product, right? So that was one thing that was critical in sort of our hypothesis. The second thing is that we also looked at the funnel conversion rates and that buying experience. And this was important early on, but especially became important as we continued investment in that buying experience. And then the last thing that we looked at was frequency of use, right? And in this case, use equals purchase. And so it was really that frequency of purchase. And so what we wanted to make sure of is that we didn't have a lot of like one and done buyers, right? People that would try it, kick the tires once and then not come back and be repeat users of the product. And so what we found was that we had positive indicators on all three of these metrics. And so we did exactly what we set forth to do. We expanded the buying experience and we expanded this out to more products. So one example of incorporating that PLG motion. In the second scenario, we had an existing product that was sold again via traditional kind of sales motion. And this was a high revenue producing product, right? Very significant. But the attach rates in this case, if you looked at our overall product attach rates, were actually shrinking. And that was interesting. And really, why was that? It was because we weren't penetrating into our customer base and any of our new logos as fast as we were growing our overall customer base. So our actual customer growth was outpacing, right, the penetration and the growth of this particular product. So that was one of the things that, was kind of an early signal for us, that there are some challenges here. The other thing we looked at was enrollment rates, right? For each one of our customers that was using this product, what percentage of their workforce was actually using it? And what we did see was that remained a high percentage. It remained a relatively static number. So that was a good signal. It told us that people that liked it really loved it. They were paying a lot for it. And yet, though, we really couldn't penetrate into these other segments. So we opted to shift this product into maintenance mode. And what that allowed us to do was to really minimize costs for that product and reallocate that investment to other high ROI initiatives. And then I'll give you one final example, which is we had a new data product. And data products are interesting products because oftentimes they have this network effect, right? Where you need more than one participant. The more participants you get, the more valuable it becomes to the network. And when we started this product, there was a lot of customer interest, right? Many folks said, oh, this is great. We really are interested. But when we got to the stage of needing early adopters, we couldn't get traction. And so we couldn't overcome this cold start problem of needing multiple customers to really create this network effect with the data. So we tried pivoting a couple directions, but honestly, those were unsuccessful. And so we had to make the tough call of saying, we're just going to stop investment in this product altogether. And that's what we did. So, hopefully this range kind of gives you, range of examples kind of gives you some insight into some of the things that you might look at, in order to understand, well ahead of revenue, are there other leading indicators that I should be focused on that will tell me, am I going down the right path, right? And again, I think for each product, the key is determining what that data is that you need, what those signals are going to be, measuring it, and then you have to inspect it, right? Now, it would not be a dragon boat webinar without seeing a little dragon boat. So I'm going to show you a little bit of what this would look like in the dragon boat product. And what Dragon Boat is really doing here is it's making it easy to facilitate those decisions that I just referenced, right? So this screenshot really represents the set of initiatives that we're deciding on. And each one of these cards will show the outcome on the left. It will show then the output on the right and those associated KPIs. And so just walking through this again really quickly, product A, that first product, is the one that really demonstrated a lot of progress. You see outcome, being 86% in the green. Metrics are all trending in a positive direction. The work completion is really moving along. No red flags. So again, we made that decision. Hey, let's expand. Let's keep investing. Product B really showed, potential with outcome progress at 60%, right? We were tracking to goal. Work completion nearly finished, but the metrics were mixed, right? We had this, high revenue that plateaued and our attach rate continued to decline. So again, we chose to shift this product into maintenance, based on this, mixed data, but, high revenue. And then I'll say problem C was clearly problematic, right? The outcome was behind and off track, even though most of the work had been completed. The metrics weren't being met, and there's lots of red flags, that we're seeing. And so we had to make that tough call and divest from this product, just because of both the poor progress and the KPI results just weren't what we were looking for. So hopefully that shows you a little bit about how Dragon Boat can help facilitate that. So now I'm going to bring us back to those intra-year investments. We've started high, big strategic initiatives where we're putting a lot of, our R&D horsepower, but there's everything else that we're working on. And so let's go back to that rice and the 45-ish% of you that are in the none category. Maybe this will change your perspective. So in my opinion, I think the most important takeaway for rice or any prioritization, I'm going to keep saying it, is consistent evaluation and consistent use. So why? Consistency matters if you want your product managers to assess the impact consistently, right? You want them, for example, to say, hey, these things all look like a small. And when you've got a large team of product managers, if you let each of them make that decision independently, then a lot might get lost and you might not be able to actually evaluate across your portfolio in the way that you desire. And so my advice to you is to really give your team guidelines, right? So at Checkr, what we did was we actually broke it down and we said, hey, for revenue producing impact, things that we anticipate to produce revenue, kind of here are the breakpoints. This range equates to a small, this equates to a medium impact, this equates to a large impact. You can easily do the same thing on the cost side, right? And so for the numeric, more quantitative things, you can sort of give them a range to make sure that they're mapping it all to the same thing, which allows you as a product leader to, again, make that evaluation across your portfolio. Otherwise, you're going to end up with sort of special, unique snowflakes within each one of your products. On the subjective side, right, on the qualitative side, it's always going to be tougher, right? But what you can do is give examples. And so I would encourage you to kind of highlight examples at the various impact levels so that somebody can look at that and say, hey, what I'm doing kind of looks a lot like this. And so I think it's right to map this to a medium impact. The other thing I'll say about, rice is going back to that consistent use. And that is key because it really paves the way for you as a product leader to both locally and globally optimize across your portfolio of investments. So what do I mean by that? Using rice, as I just described, right? Every product manager can make those decisions around what they're investing in. And so that's pretty straightforward. It becomes a math problem, right? As I start to work through that analysis and I plug in those numbers, is this bigger than this, right? It's It's a way for them to check their gut in terms of what they're prioritizing and making sure that what they hypothesize is put into the system and therefore reflects sort of the overall priority. But as you as a product leader, you're also looking globally at where you want to invest. And what I would often do is I'd want to kind of peek below the waterline. What are the things that the team wanted to work on, but they didn't have enough resources to do it? And therefore, they wouldn't show up on their roadmap. And I would ask for that in our roadmap review sessions. And I would do that in our roadmap review sessions so that I could have a checkpoint after reviewing the roadmaps of all of the teams, and I could make that reallocation decision. And I think this is where RICE gives you yet another tool, right? To say, what are those things that are high value where I might want to shift work to a team or move, people to a different team in order to make that global optimization across my portfolio. It's really allowing me to tune that investment strategy based on those business outcomes. I see we are at time. I think it has slipped away from us. And so I just want to pause for a minute and make sure we're on track, Alisa, to keep going.
Yeah, I mean, I think that this content is very worthwhile.
Okay.
Maybe what we could do is take a look at that look back advice that you had based on your experience, because I think that that is extremely crucial
Yep.
and definitely worthwhile. And maybe we'll just skip the poll that we
Okay,
had
we'll
planned.
skip the poll. But I'll be remiss if I tell you, though, if I don't tell you this on RICE. RICE is part art and science. And so the math is going to give you the science, right? But there is a piece of art. And so I would say that sometimes, and that's why I highlighted this very specific example, cross-product initiatives, sometimes these are company initiatives, you will need to make sure that you invest in them, even if they don't RICE out, right? Meaning that if I'm working on a product that has a lot of customers, some things may fall below the RICE line from a mathematical perspective, but this is where we as product leaders have to make good judgment. So I'm going to skip this poll, even though I'm desperate to learn from you all, and just say that you do need to look back, right? You need to go back to those key metrics that you outlined in your business case and make sure that you are evaluating those. And what I have found, my tip for doing this for all of you in the interest of time, is to front load your quarterly planning process with this data. So when the product managers present to you, take a look at that look back data, because that will also set the stage for the rest of your conversation around that quarterly planning process and what you have indeed prioritized. So that was a lot. Too much, one would say. So in summary, I think what I want to leave you all with is that consistency is key, right? You've got to consistently use these things, and you have to make sure that we're all measuring in the same way, that you are, the level of investment that you're making, decide, when it warrants a business case and start using it. Use RICE or some other prioritization methodology to really aid in that prioritization. And then lastly, I'd say look back to make sure that you are achieving those business results that you expected, because that is what product ROI is about. That's how we learn, that's how we improve, and that's how we can make these tough choices about whether to keep going forward, to pivot, or to stop. And now I have to stop.
Thank you so much, Denise. We really love the walkthrough for the real life examples that you've given, and I don't think there's another way to really get this level of understanding about these situations rather than hearing it from somebody that's been through it and has this wonderful history to look back on and to learn from. So thank you so much for the learnings. Now, before we close for today, I just want to take the opportunity to invite you for the final part of our mini series on product ROI. And this will be with Shelley Perry, the Managing Director of Scale Logics. That's happening on May 7th. And Shelley will be discussing how to connect the various functions within a product organization to capture and optimize your product ROI. So please register at the link that my co-host Anna will drop in the chat. Now, if you want to get in touch with Denise, we can go to the next slide, and we suggest you connect with her on LinkedIn. If you're curious about understanding how Dragon Boat can help you manage your product operating model, do sign up for our next group demo on April 25th. You can scan the QR code or using the link that Anna will also be sharing in the chat. Since we're over time today, we'll skip the Q&A, and what we'll do is we'll follow up about the event with you over email. If there are any questions that you have burning, please do send them to us, and that can be through LinkedIn or through our website, and we'll try to get those answered in our correspondence. Thank you so much, everybody, for joining today. Thank you very much, Denise, for sharing all your learnings. We really appreciate the insights.
Absolutely. Thank you all.